the bank shut him down, froze all his accounts, no access to money. Why? Because he restructured, DIY style. 3 companies, holding company on top, same shareholder, same PSC. The bank was not impressed. So here's where people get confused. He thought restructuring meant adding boxes, so he added a holding company. What he didn't change was control. Same shareholder, same PSC, same person signing everything. From a tax point of view, it's incomplete. From a bank risk point of view, massive red flag. Because banks don't care what your company's house diagram looks like. They care about substance. And to them, this looked like someone moving money around between companies without actually changing who's in charge. That's where reviews start. Then questions, then freezes. And once a bank freezes accounts, you're already on the back foot. This is why it's legal isn't the same as it works. Tax law, company's house, and bank risk rules are 3 completely different systems. And yes, I know exactly what video he watched to do this, because we see this exact structure all the time. And there was one deal that guaranteed the bank would shut this down. I'll come back to that in a minute. Right, let's actually talk about what went wrong here properly. Because this is where people half understand things and then make it worse. This wasn't a clever structure that failed. It wasn't unlucky timing, and it wasn't the bank being dramatic. It was a half-finished restructure, and half-finished is honestly worse than doing nothing, because now you've added complexity without fixing the underlying problem. The big misunderstanding. Most people think restructuring means adding something, add a holding company, add another entity, add a bank account. That's not restructuring. That's decoration at most. Real structuring is about control. Who owns what? Who decides what? Where money is allowed to move? And why? And in this case, none of that actually changed. He stayed as shareholder of all 3 companies, which means he stayed as PSC of all 3 companies, which means he stayed as the person with ultimate control over everything. So yes, there was now a holding company sitting there, but it didn't do anything. Control didn't move up. Risk didn't move down. Money still moved sideways. So from the outside, this wasn't a group restructure at all. It was one person with multiple companies shifting money around. Why people think this is fine, and I get why people think this works, because most content online shows you the diagram, not the process. You see a nice little pyramid, you at the top, holding company underneath, trading companies below that. It looks neat, it looks grown up, looks something like rich people do. What they don't show you is when ownership actually changes, when clearance is applied for, when banks are told, when money is allowed to move, because that part is boring and takes time. HMRC clearance. Let's talk about clearance properly, because this is where people really blag it. Clearance is not a tick box. It's not a courtesy email, and it's not something you sort later. When you apply for clearance, you're basically saying to HMRC, here's the current position, here's the mess, here's what we want it to look like, here's why we're doing it. And here's confirmation we're not trying to be clever twats. That's the conversation. And HMRC come back and say, yes, fine, we agree this qualifies for relief, or no, this doesn't. That clearance underpins the whole restructure. Without it, you're just guessing. And banks assume you are not guessing. So why do banks care more than HMRC? Here's the uncomfortable truth. HMRC are retrospective. Banks are preventative. HMRC care about tax being paid. Banks care about risk before something goes wrong. So when a bank sees new companies appear, money flows change, intercompany transfers start, but control stays exactly the same. They don't think efficient group. They think, why now? Why this way? Why no clear commercial reason? That triggers reviews, and reviews are not quick chats. A bank review doesn't start with a freeze, it starts quietly in the background. Patterns change, flags appear, someone's account gets looked at, then questions come. And if the answers aren't clean, or the paperwork doesn't line up, or it looks like someone's been winging it, that's when they freeze accounts. Not to punish you, to protect themselves. And honestly, if you're still watching this and thinking, Christ, I've done something like this, you should probably be subscribed, because 83% of my viewers aren't actually subscribed. And this channel is basically me explaining the stuff that goes wrong after people copy advice off the internet. Back to it. Done properly, this isn't clever. You own the holding company. The holding company owns the trading companies. That's the structure. Dividends go up, risk stays down. Control is obvious, but crucially, that ownership change happens in the right order with clearance in place and banks aware of what is going on. You don't just bolt a holding company on top and carry on as normal. That's the mistake. Sequencing, and this is where DIY falls apart. Sequencing is where DIY restructures just go to die. People rush, they move money first, they open accounts first, they act like a group first, all before control has legally and commercially changed. So now you've got behaviour that doesn't match structure, and that mismatch is what banks react to. Now, if you're watching and you're thinking, yeah, I've already done that, don't panic. But also, don't touch anything else. Because once you're in a half-finished structure, every move matters more. This is where people make it worse by trying to fix it themselves. They start changing shareholders without clearance. They move money again. They open new accounts. And all they do is create a bigger trail. This is why we built the tax game plan. It's the foundations that you need to lay first. It's in the link below if you want to grab that. It explains all your tax stuff and everything. When this client came to us, we didn't rush. First, we stabilised the banking position. That alone takes time. Then we documented intent. Then we mapped the end structure properly. Then we dealt with HMRC. Only then did we restructure. Slow, boring, correct. And if you're running multiple companies or you've copied a structure like this, that's when you get it reviewed. There's a link below to book a call with the team. No pressure, just making sure you don't blow your own legs off. The mistake here wasn't ambition, it was skipping steps and assuming boxes equal substance. A structure that looks right can still be completely wrong, and banks don't care what you meant to do, they care what exists. Next video, I'll show you the checklist we use before any restructure happens, because this mistake is everywhere. Don't forget to subscribe. I'll see you in the next one.